Hey everybody, how are you doing? We have got Grace here and Mark in Bangladesh. Grace is in New Jersey, Mark's in Bangladesh, and you got Wayne from Colorado. I'm not putting my webcam on just because it's bandwidth issues, and you don't need to see me anyway. It's Grace that's going to be talking. And I just want to introduce her again. I want to start out by thanking her again, because this is now really the fourth session on financial planning for all of you. And this is going to be our last session for a while. She's actually going to put together something else, and we don't know exactly when in the future, but she's already talked about how we'll probably put together something else that she would then come back and talk to us about again in the future. So we'll know exactly when that'll be when we talk about it. But I want to lastly thank all of you for coming. Be ready to take some notes, and you'll get lots of good stuff. Please put your questions in sort of as they come to you. Grace will probably answer them near the end, but if you've got it, it gets to you, we'll make sure they all get answered. And I think that's all. One announcement: there is a what we call SDMC, Sustainable Design Masterclass session on Thursday. If you got your announcement Sunday night, which we send out every Sunday night, it didn't have a specific time or a link for that. So I'm going to send out another announcement to you tonight that will have that link, so you can be able to go and watch that session. So with that said, I'm going to turn it over to Grace, and go for it, Grace.
Okay. Good night, everybody. How are you? Tonight we're going to talk about really putting together a financial portfolio. And just as a reminder, this is not intended, this is for educational purposes only, and it's not intended to be investment advice. Okay, so what are we going to talk about? We're going to talk about what is asset allocation. This is a term that you hear about all the time, again, in the general press. And people are sometimes confused by it, so we're going to go through it bit by bit. And then there's another term called diversification. And very often they are mistaken to be the same thing, but actually asset allocation and diversification are two different terms. And of course, this other one, rebalancing, and I'm going to leave that as a mysterious term, but we will get to explain it and why this is so important to your overall performance of your portfolio or mix of investments, whatever you want to call it. So, as I said this before, that you already have skills to manage your own investments. Very often, this is what makes people stop really going forward and actually putting money into investments, because they are so afraid of making a mistake, especially women. Women, if they don't feel that they understand, will not take an action, where men will take an action. But even men sometimes are a little hesitant about delving into the world of investing. If you recall last time, we talked about the different tiers, right? So budget is the first. The second one is really saving. People generally don't have an issue with saving because they know that it's a guarantee, right? There's an interest rate at the end of the month. It's going to be just a little bit higher than it was at the beginning of the month. Where in investing, you're not sure, right? Things go up, they go down, you can take a loss. So we're going to take a look at this in a careful way, but I just want you to understand that this is not really rocket science. There are some basic principles that we are going to go over, and then it really takes more diligence in terms of reviewing and looking, as opposed to, in the old days we used to say, set it and forget it and don't even open your statement. Well, that's not true anymore. The market is a little more volatile. because of politics and just everything that's happening. So things do require some attention, and that's really what it takes. So let's go into what is asset allocation. So I like to think of this as making soup. You have different ingredients, right? You might have, meat, potatoes, carrots, other different types of spices. That's really, the asset categories are like the ingredients, okay? So you want to come up with your own personal mix of how you're going to create your portfolio or your investment mix, right? So you're going to look at a few basic things. How long do I have to invest? How much tolerance do I have of risk, or what we call the pillow test? So can I sleep at night knowing that my money is invested in a certain way? There are things called investor profiles that are available on multiple sites. I can go through that a little bit later about different sites that you can go on to look and come up with your own investor profile. We're going to look at what your goal is. And if you remember in my previous presentations, I'm always talking about the job of your money, right? And if you understand what the job is, right, the intention of the money, it's a lot easier to figure out how to invest. And this is another, what I find people do a lot. They try to, match what's in the popular press, what's the hot topic of, is it, remember when different types of investments, I don't even want to date myself, but sometimes things are hot. Small cap, large cap, it doesn't really matter. If you know what the job of the money is, it's easier to figure out how to invest, right? And so examples of that would be, I need this money to produce income for me. This is going to be my income engine. So you're going to invest it slightly more conservatively because you know it needs to be reliable. If this is going to be your fun money, then you can invest it really any way you like. If it's going to be for emergency money, then again, it needs to be more conservative. So understanding the purpose, the job, whatever you want to say, it's critical to knowing how to invest. So let's look at the time horizon. So things that are less than 5 years or short have to be more conservative. Because, again, the job of that money is to be there and to be reliable. So you're going to make a trade-off. For the fact that it's available to you, you're going to make it more conservative, which means you're going to have less return, right? You're not going to get 7 or 8%. In today's market, you're going to get 1 to 3%, okay? And sometimes people call me and they say, oh, I've got this money in my checking account, and it's earning nothing, and I want it to earn more. Well, what do you need it for? Well, that's my emergency money. Well, then you can't have it invested in the market, because if you need it for an emergency and it's invested in the market, and the market happens to be down, well, now you don't have all the money that you thought you did in order to use. So, if you have more than 10 years, right, a longer time horizon, you can afford to be more aggressive and to have more stuff. So anytime, when we did this last week, we said 1 to 5, 6 to 10, and anything over 10 is really considered long-term, and retirement would be one of those. So retirement is one of those things. So as you get closer to the goal, right? So if I'm planning for retirement and I have 10 years, as I get to year 5, right, now maybe my allocation needs to continually change. So this is not a set it and forget it. Asset allocation is a constant adjustment because time moves, right? So as you get closer, you're going to keep refining the allocation to meet your goal. So when I get closer to retirement, I may need to make it more conservative, even though I may start out here at the plus 10 mark and have it more aggressive. But as I get closer to retirement, I'm going to make it less aggressive. Okay, now let's talk about risk tolerance. Again, this is another concept that we hear about a lot. And basically, this is your ability to lose money. Like some people, and theoretically, the younger you are, the greater ability you have to weather any losses in your investment because you have time. Time is on your side. But I have met plenty of 25 or 30-year-olds that don't have any tolerance for risk because they're not earning a lot. And psychologically, they cannot deal with, that negative sign on their balance, when their statements come. So this is something that is really critical to understanding about yourself. How much can I tolerate? And if I had a pen, I would do this squiggle mark like a roller coaster. So if you imagine, I don't know how much people like roller coasters, but there were the really baby ones that you put your 5-year-old on, which have very little movement, and some people that's all they can tolerate. Then there's those middle roller coasters that have ups and downs, but not too much. And then there's those ridiculous ones that have loop-de-loops, and those are the aggressive investors. Now, very often, I have not met very many aggressive investors that can really tolerate that constant volatility, that constant up and down in the market. Very few people can really tolerate that. More people tend to be on the conservative side. But this is what happens if you are not in tune to your risk tolerance or your risk profile, when things happen in the market and it doesn't meet your risk tolerance, you move out of the market and you are actually hurting your performance. So there's a slide at the end about behavioral, so I'll save that for the end, but it is critical to understand who you are as an investor. So if you are not sure, if you have a 401k, a 403b, an IRA, whoever the carrier is, generally will have what's called a risk profile or investor profile on their website. And you can go in and look for it. There is a company, American Funds, all these companies, Vanguard, they all have them on their website. Fidelity. But also there's another one, dinkytown.com has fantastic calculators of all kinds, but they also have a risk tolerance questionnaire. So it's important to spend 15 or 20 minutes. Now, some of them are very lengthy, so pick the one that maybe doesn't take an hour, but there are plenty out there that are 7 to 10 questions that will hone in on who you are as an investor. Very critical. And the other thing about this is, again, this is not a set it and forget it. You're going to do this every few years when major things happen, such as a huge job change, a move, change in status, meaning that you're going from single to being married to, this is another thing, very often married people do not have the same risk tolerance. The wife will have, as I've mentioned before, women tend to be much more risk averse. They tend to be more conservative investors, like to stay the course. Men tend to be a little bit more aggressive and like to make a lot of trades. So very often when you have a couple they do not agree on how to manage the money. So this takes a lot of conversation and sometimes actually splitting some of the money so that some of it can be managed the way she would like it and some can be managed the way he would like it. Very important to discuss these issues with your partner, really. Okay, so enough about that. Let's talk about investment goals. So again, every investment has some degree of risk, right? The greater the risk, the greater the potential return, right? So again, if I was an aggressive investor and I'm taking a lot of risk, and I'm talking about having a range of maybe, on an aggressive side, it could be plus or minus 40%. Conservatives usually within 10 to 15%, moderate is 20 to 25%, plus or minus. So again, knowing how you are as an investor, understanding the job of the money helps you figure out how much risk you're going to take or you can tolerate. So what are these ingredients, these asset classes? These are the three basic ones, right? Stock, bonds, and short-term investments. Within the ingredient of stock, there's lots of variations, right? Just like there's a million types of potatoes. So you have your stock mutual fund, you have stock, and a mutual fund is a collaboration of different types of stock put into a bundle, right? That's a mutual fund. And so you can have an aggressive mutual fund, you can have companies that are large, and so those are called large caps. You can have companies that are mid-sized, those are mid-caps, and then you can have small caps. Then you have life cycle funds or target date funds that match your date of retirement, usually typically 65, and they manage the portfolio completely without you, basically. They're going to match it to how old you are going to be at retirement. Exchange traded funds, which are kind of the new buzzword. You hear these a lot. And these are you could have, the flavors on exchange traded funds are enormous. There's all kinds of exchange traded funds. They're kind of like an index fund. Very low fees. You need to keep them for a long time. Bonds, you have individual corporate bonds, which are usually, bonds go by the rating. The higher the rating, the more reliable, and the less risk. So when you hear bonds, usually AAA, AA, A, B, double B. Once you get into double B and below, you start to get into what's called a high yield. And those tend to be more risky than corporate or AAA. Then there are muni bonds, which are municipal bonds. Those offer a tax advantage. So the higher tax bracket you're in, the more beneficial a muni bond is. And you are investing in a municipality to help them fund their project. And then again, mutual funds, but they're in bonds. And again, bonds can have the same thing like stock. Here you have different names for them, but there are different types. Aggregate meaning a bunch of different types. They have them by duration, which means how long the bonds within that mutual fund are going to mature. So they're all flavors. Short-term investments are usually the easiest thing to understand because everybody hears about these. These are your money markets, your stable value, your treasury bills, and so those are the things you hear about. Your checking account, savings account are all short-term. Okay, so what is a stock, right? So a stock is you're actually owning a piece of that company or having an equity share. That's why sometimes you hear the terms interchangeably, stock and equity. And again, there are stock mutual funds, which we just went over. That's the collaboration of different stocks. And again, multiple flavors. You have different sectors, meaning that you can have, I want only companies that are invest in farming equipment or something like that. You can have that. I only want to invest in healthcare. That's an industry. I want to invest internationally, and I want to actually specialize and only have Pacific Rim or Asian countries. You can diversify as intricately as you would like. Now, to start out, you're not going to have that much diversification. You're going to have your basic diversification, which I haven't described yet, but you're going to have those types of ingredients, the basic ones, just like if you made a basic soup. As you become a better cook, you start to experiment and have an ingredient list that's, a page long. But in the beginning, you start small, okay? You want stocks have a remember we said about the horizon, the time horizon. You're not going to use stocks if I have a very short-term goal. This is for a long-term goal, 10 or plus years. Now, you will also hear a term called value and growth. So value are stocks that you're buying on sale, right? So they're underpriced at the moment, but because of the company's business plan and product, they are geared to have a big upturn. So a lot of people like value stocks because they have sometimes that big burst. But you might have to hold something for a long time. You do have to, understand what you're buying. And again, sometimes people say, well, how do I know? Well, buy companies or buy into mutual funds with companies that you know. You don't have to get too creative. Go to companies that you know. So if farming or healthcare or whatever it is something that you know a lot about, then start there. So the higher the risk, hopefully the potential for higher return. Now, we'll talk about diversification in a minute, but you are going to have multiple types of stocks. You're not going to just have one type. So that's the other layer of asset allocation. So on the bond side, this is an IOU, right? I am lending these companies money so that they can invest and do the projects that they want. So this is why bonds typically are less risk, because you're going to pay back, as opposed to the stock where you're not really sure what's going to happen. So these are debt securities. They're issued by governments or corporations, municipalities. They generally pay interest, right? When you actually buy what they're promising to pay you, whatever interest rate, and when the bond matures, you're going to have that interest. It's kind of like having a CD in a piece of paper. The bonds, very often people tell me, well, bonds are safe. Well, no, not really. They can go up and down. You can lose money in a bond fund or with a bond, because bonds are queued up to the interest rate market. So if you're buying a bond and interest rate and you're promised, let's say, 4%, it's high now, and interest rates start skyrocketing, and now a year from now I can buy a bond at 6%. Well, my bond here isn't worth that much anymore. So that's how you lose money in a bond. The opposite is true. If I bought that bond at 4 and rates go down, and I now only buy one at 2%, well, now my 4% bond is very valuable. So that's how they go up and down. So this is moderate risk, moderate potential return, and again, This can be used, I like to think of bonds as shock absorbers for your stock. They are not there really to be the big breadwinners in your portfolio, but they are there to absorb the shock of the market ups and downs. And then, of course, short-term CDs, T-bills, money markets, stable value, these pay interest. You know that you're going to have low risk, low return. But again, they are here to add liquidity to a portfolio. So very often when the market is starting to get very volatile, you'll see fund managers pull some money into cash so that they can maneuver and buy and sell with that cash portfolio. It also, again, adds stability to a portfolio. Okay, so what is that? Why is it so important? Well, because these ingredients do not react to each other in the same way, typically. Unlike 2008 where everything went down, typically when stocks go up, bonds go down. When international goes up, our U.S. domestic stock market might go down. So you want to build this portfolio with things that are up and down, because typically one of those things will end up being the winner. So you want to have things that act or opposite to each other. This helps keep your investment returns on a steady pace, and it helps keep your goals. It also helps reduce risk. So they've done studies, the more diversification, well, I'll get into that in a minute, more ingredients you have in the top, the less risk. And that kind of makes sense, right? Okay, so here's a good illustration of what I'm talking about. So the large cap growth, I don't remember what color it is, it's the purple, the pretty royal purple. And you can see that it's had its ups and downs. This is a short duration. And then the other ones are mid-cap. So if you have a diversified portfolio or an asset-allocated portfolio with multiple asset classes or ingredients, you're going to have one of them every year is going to be a winner. But they rotate, as you can see. So it's important that you have these ingredients there because you never know what year that one of those particular ingredients is going to do really, really well. Okay, creating an investment strategy. So here, these are some sample pie charts is what they're called. A conservative investor still, if you notice, has 20% in stock. And you might say, why is that? Because remember that there's that corrosive, invisible, destructive force called inflation. And so there is a price to be paid if you have everything in money markets or CDs. Because, first of all, we said last time that if you have something at 2%, it takes 24 years for that money to double. You've got to have a lot of time, or you have to have a lot of money in order to be that safe. Second, remember that over time, your money loses purchasing power. And so without stock, your money starts to devalue. So having everything in a 2% of the money market is not going to give you that. So the opposite now, if we look at the aggressive investor, they too have some bonds in there because, again, it acts as that buffer. Growth, 70% stock, and about 30% in short-term in bonds, and balance is usually a 50-50 split between stock, bonds, and short-term. This is just typical. And again, if you have a 401k or an IRA, often those carriers or companies will have their own asset allocation mix. And it's always good to use an allocation mix that's has had third-party review, like Morningstar, or if it's been And a lot of 401ks will advocate for a third-party allocation model, and that's what this is, an asset allocation model. So the connection between diversification and asset allocation, right? So we said don't put your eggs in one basket. It enhances your return because the more ingredients in your soup, the more diversified it is. So let me just give you a very quick example. If I have 5 stocks and they're all in large companies, but I have 20% in each, is that really a diversified portfolio? No, because they're all in the same category. So I may want a stock that's large, I want a mid cap, I want a small cap, I want one that's international, I may want one in a special sector. That's diversified, okay? It helps you, again, reduce your risk. It reduces that up and down of the market when you're more diversified. So here is, this is the Morningstar investing dialog. So you'll see this on a lot of investments when you look at their, what they call their fact sheet. So you'll see here low risk, right? You've got large cap value, large cap blend, large cap growth. These large is defined as $5 billion or more. So this gives you an idea. Remember we said value is things that are on sale. Blend is having both growth and value. And growth are companies that have established track records and are set for a pattern for repeated growth. So you're going to have many different, you can have many different combinations here. Depending on your risk tolerance. So here is an example, right? So generically, I need 50% in stock. Well, in that, I'm going to have 40% large blend, 5% small cap, 5% international, 10% short, and 40% bond. But here, when you look at it here, it's just 40% large blend, right? So I have taken this stock portfolio and broken it out into different segments. That's really what diversification is. It's digging deeper down into what you are actually investing in. It's the next layer down. Oops, we don't need that. Sorry, that doesn't belong to you. Life cycle funds. Okay, so here are, like we said before, target date funds. So these are investments that you are not really managing at all. You're just picking a point in time in the future, and the fund manager, Fidelity, Vanguard, all these different companies have these, and they are changing that allocation as you get closer to that date. That's all there is. So a company, a 2040 fund or 2050 fund is going to be more long-term, which means it's going to have more stock in it and more aggressive than something that's short-term, because that means I'm going to have more bonds in there. Okay, another really important concept. This is a tried and true method to help keep your, this is the automatic weeding function here. So reasons to change your allocation, right? My time horizon has changed. Something has happened in my life and I need to either make it longer or shorter. I have a change in my goals, so now, or I have a change in my life now, I might need to save for college. Now I don't need to save for college. I'm going to save more for retirement. I am going to start a new business. I am now getting closer to my retirement, so I want to change my allocation. That's really common. So without rebalancing, and what rebalancing is So again, let's just use that very simple example. I have 5 investments, all at 20%. Well, at the end of the year, the things that really did well might be at 25%, and something that did poorly might be at 15%. So without the rebalancing, your portfolio has a chance to get out of whack, and again, not in alignment with your ability to tolerate risk. Remember, everything has to be in alignment. Otherwise, investing can get very complicated. So let's do some more examples of this. So you want to bring, so my example, I had 5 investments at 20%, and if one went to 25, I've got to bring it back to my original asset allocation mix. I want everything to come back at least once a year back to that 20, 20, 20, 20. The reason I do that is because it's a very simple process, right? I'm going to buy low and sell high. So I'm going to take the profit that I make when I'm selling high, and I'm going to buy into the stocks that are basically on sale. So this helps keep the emotion out of investing. Very often, I mentioned this before, emotion gets in the way. And so we get greedy and we say, you know, I'm going to hold on to this for a little while longer and it's going to go higher, and then meanwhile there's a loss. Or when things go down, we sell at the wrong time. So you want to rebalance every 6 to 12 months. Okay, we talked about this at the very beginning. So over a 20-year period, the stock market, the S&P 500, has done 9%. Stock-only investors, people who only invest in stocks, only generated 3.8%. And people in life cycle funds only generated 2.5%. Now, why is that? Because people go in and out of the market at the wrong time. There's no reading of their portfolio. And when things go down, people sell everything and lock in their loss. And this is probably the most important thing that I want you to take away from tonight. You need to have certain triggering events or that rebalancing so that you know that every year or every 6 months your portfolio is automatically going to be put back to the way that you originally wanted it, if that matched your risk. And when things go haywire in the market, you know that that rebalancing is going to bring you back to that. You don't have to do it yourself. Okay. This is just an example of rebalancing. And I just kind of did that. You had your portfolio, you started at a 60%, it ends up at 80%. You're going to sell off that profit of 20% and put it back into those other investments. And it keeps going like this annually. Most often it's annually. Okay, so with asset allocation, a couple of things that I need you to remember. One, you need to find out who you are as an investor. What is your asset allocation, your risk tolerance, your profile, whatever you want to call it. Remember that there are all these websites out there that you can take the investor profile questionnaires to come up with who you are. And that is going to help you figure out how much risk you can take so that when the market goes up and down, you are going to stay the course. The other thing I need you to remember is, about money has to have a job. And when you identify that, it will make it so much easier for you to choose the proper investments to match the job. That's very critical. And then, again, using a rebalancing strategy to help bring you back to what your comfort level is in your portfolio. Okay, Wayne, that's it. Anybody have any questions at this point?
Awesome. Thank you again. As always, great job. Actually, this was really some great detail. So I'm waiting to see, and we'll see some questions, I'm sure, here in a minute. But everybody, as you see it up there, Grace is being incredibly gracious and throwing out her phone number to you there. So if you can, and be thoughtful, and don't just ring her up for just kind of a crazy thought or question. But if you do have something that's legitimate, I know she's going to be excited, because we talked about how as we create a course from these 4 sessions, that one of the things we might offer is a question and answer time. And I could see her perk up and be very excited about that. So I know she likes to answer questions. So I have one. What, on the rebalancing side, what do you think is, how often should you be looking at rebalancing? Frequency, time frames.
Well, typically, if you're using an allocation, let's say you're using Fidelity or Vanguard or some of those types of investment houses, they will typically do it annually. I would say annually is probably enough. If you have a very complicated investment strategy, you may want to do it as much as quarterly. But for most people, annual or 6 months at the absolute, because then you're not getting enough growth in there at all. So some people do it also more frequently when they think, like now, that the political environment is going to create potentially some ups and downs in the market. You may also want to do it more frequently at those times, just to be a little bit more defensive.
Makes sense. So that's a great segue into what my next question is. Okay. By the way, come on, guys, ask some questions. Robert, you're usually really good at doing that, so throw in something. This is clearly going to be my personal opinion, so I will throw that disclaimer out to start. But I've been a follower of a prognosticator / visionary / economist for probably 30 years now. Maybe not quite that long, but named Harry Dent. Does that name mean anything to you?
Yeah, I've heard of him.
Well, he's been fairly quiet since the recession ended, but recently he's gotten to be very vocal again, and he is very concerned that we're in for a big market correction. Matter of fact, one that's maybe more dramatic than the 08 correction. And he's got lots of logic and some emotion. The guy's been really accurate. That's why I said 30 years. He's predicted just about every bust sort of circumstance over the last 30 years, and with some pretty good accuracy. So again, I'm giving what Harry Dent's opinion is here, and then saying that I personally sort of think he might be on the right track. That said, I'm not asking you for your real opinion, but if you feel that way, what should that do to your overall strategy here?
Well, okay, so here is my my view on that, because you never know exactly when these things are going to happen. And you can stay out on the sidelines and, be protected. And so if you really feel that the market is up for correction, and he is not the only one. There are many people that feel that way. Right now, the market is still, for whatever reason, is still continuing to go up. But you can start to get more protective, meaning that you start moving more things into fixed income, into safer investments. There are defensive types of stocks. There are defensive even bonds like tips or inflation. Gold, people love gold when things are haywire. So there are defensive strategies to take in your portfolio if you really feel very strongly that this is going to be, that this correction is imminent. Sometimes that bites you too, right? Because you've taken this protective stance, and as long as you're comfortable maybe staying in that stance for quite some time, because the correction may not happen when you think it does. So now you're missing out on that potential market growth. So, if you're going to take a position like that, you have to be willing to stay in it for a while, because you just don't know exactly when that correction is going to happen. And the same thing on the upside, right? So I've stayed in this thing, the market does have a correction, so when do I go back in? That's really the big question, and very often people will wait. The market's at the high again, and then they go in, and that's typically really the wrong time to go in, because you're buying things at the height of the market. So you're paying more for every stock that you buy. So even though this is very contrarian, people will go in as soon as the correction happens and buy, because now you're buying on sale. But a lot of people can't. This is why everything is tied to the emotion, right? It's just psychologically too hard to go into the market when it's down, even though that really is the best time, because you're buying everything at a low price. So that
makes sense. Yeah, that's great. Thank you. John has a comment, really, but I think we could phrase it as a question also. Depending on what you're investing in, rebalancing too frequently could also incur excess trading or mutual fund management fees.
That's true.
So what are your thoughts on that?
No, that's very true. So that's why typically we really want to do it once a year, unless this is really complicated, because you're buying off and selling. That's why if you have to do it yourself, rebalancing is difficult, because you're selling, you're buying. There are a lot of trades that you're making. If you use, a company like, the big low node companies like Fidelity, Vanguard, all those kinds of companies, they have automated programs, and so it's a lot easier to do. And if you have literally a stock portfolio, you have to be aware of the tax consequences also, because you're buying and selling.
Okay. What are appropriate fees today, in your opinion? I mean, are about any fingers pointed at any specifics, but I know in the past that there's been some fee-based managers that really do charge rates that are higher than the market. Is there a target that you would think today is appropriate in terms of a fee percentage?
Typically, it's 1 to 1.5%. and the more money you have, the lower the fees. We are now, I don't know if you've heard about this, but the Department of Labor has come out with a new, quote, fiduciary rule, and it is a very stringent rule. It's probably the largest reform since 1972 with ERISA. And basically what this rule is saying and doing is that advisors now have to provide the best and low fee platform that they can, and that they're getting away from transactional trade, meaning, I'm going to buy something for a commission, that pretty much everything is going to a flat, fee-based structure. So you're going to see a leveling of fees. This law goes into effect June 9th, unless something else comes up that will stall it. But the industry is ready for this ruling. So you're going to see a lot more disclosure about fees. You're going to see more service for fees. And the downside to this is that the very small investor may need to do automated investing because of the costs involved. Brokers and fee-based planners are not going to want to take on these small investors because of the cost to them and the regulatory burden that's on them. So you hear this term called robo-investor. That's what those are. They're going to go through an algorithm. They're going to ask you questions, and they're going to help you pick your investments on a computer, basically.
Yeah, that is different.
That is. It really is.
What about, again, your opinion of the difference between a fee-based planner, fee-only based planner, and or advisor, and a percentage, one that is making their income off of whatever it is you buy through their advice? Do you have either a neutral or positive or negative feeling about the
you're
choice?
Not going to see fee only unless you're buying a plan. So typically, if I want to go to a financial planner to have my plan actually built out, which is a complicated thing, very often those are fee only. So they'll charge a certain amount per hour, or for a certain type of plan. A basic plan might be $1,000. A complicated plan might be $3,000 to $5,000. And then they will charge a fee based if they're going to be the person who's managing your portfolio. Then there will be a percentage attached to it, because it's not that lucrative to just do fee only planning unless you've got a tremendous book of business and you don't need a lot of money. So typically you'll go to a fee only, or your planner will have, this is what I charge for these types of services, and this is what I charge for the management. And you're going to see a lot more of this in the coming year. Almost everything is going to go to flat fee. The only thing that's going to be commission generated are certain types of annuities, life insurance, those types of things that are outside of the investment realm. But everything in the investment realm is going to go to fee. And what I mean by charging a percentage.
Makes sense. All right. Well, I don't see any other questions. And gosh, you've been great, Grace. I just know that we'll have even more thoughts and comments from people watching the replays. Before we started tonight, I asked Grace about whether she thought that even high schoolers or college could take advantage, and we both agreed that college could with very little changes. Maybe there was some tweaking needed for high school age, but I don't think you can learn any of this too young. If you're at all generating some kind of a part-time revenue for yourself and you're looking ahead, at least in the college age, you should be thinking about it. And so if you guys don't mind, throw in some ones if you enjoyed this. That would be helpful for just kind of our online applause. Grace, thank you. Thank you guys for being here with us. Mark, thanks for coordinating as always. And Grace, we'll be in touch to talk about doing the course that we talked about, and then also when you're ready to come back and talk a little bit more. And please update us on any changes, even career-wise, that I know you're still thinking about some things, and if that happens, well, let us know. So.
I will. Thanks so much, guys. Take care.
All right. Adios. Thank you, Mark. Cheers. See everybody later.
Bye-bye.